Well, thanks again, folks, for making the time here today. I really appreciate it. I know that this has been a really exciting time for us to kind of come together, set up the webinar, and this whole week. We've got lots of good content here for everyone. Everything from some basics like this one to something a little bit more detailed oriented coming up on Friday about financial modeling and kind of digging into how to create financial forecasts and models that you can actually use to run your business. In the meantime, I just wanted to kind of get started. A little bit of housekeeping here. I have everyone on mute for now. Do bring your questions. There's a Q&A session that's going to be set up for after this presentation, so we can kind of talk about some questions that you might have. This is a relatively simple session on financial statements for co-founders, founders, technical startup folks who need some general guidance as to what financial statements are, why we have them, why we care, and whether or not that's really where we should be paying a lot of our attention or not. They are important, but other things are as well. So we will kind of dig into the details there. I just want, if you don't mind, I'm going to ask at least one of the attendees to just send me a quick chat here, just to make sure that you guys are hearing me okay and seeing the presentation and me on the video. That would be great. All right. Okay, thank you, Sean. I appreciate it. Thank you for giving me the heads up there. Fantastic. All right. So the presentation is relatively short, but only because I like more collaborative, discussions, and I like to have enough time for Q&A. That said, we'll dig into some details into here, and as you guys have questions, please, you should see a Q&A session button on your screen. Go ahead and pop that open and send in some questions as we have time. I'll go through them and attempt to answer some of them as well. That would be great. All right. So to start that off, here we go. So financial statements, it's a question that, we all know the financial statements are important, but why? And especially when you're a startup, what should you be paying attention to? At the end of the day, are we worried about, reporting what's happening in our business? Or are we more worried about actually getting the business to where it needs to go? And we want financial statements to be both useful, but at the same time not distracting, especially right now when you're at an early stage, you're just getting your legs under you, you have some sales in, and you just need to grow. So some of the things we'll cover in this session: who makes financial statements, who wants them, what's in them and what's not, and how can they help us. And I left it as generic and open as that, primarily because there's a number of ways that financial statements can be built. If we have any CPAs on board here, you'll know that there's financial statements can be very basic, very rudimentary, or they can be very complex, and you have these footnotes that you build out and an MD&A section, so on and so forth. Not too much of that becomes important until you're at a certain level and you've raised enough money, and that you have investors on board asking for that level of detail. All right, so to that point, let's keep going here. So who makes financial statements? You're more than welcome to try to write your own, but for the most part, software, there's plenty of software out there: QuickBooks, Xero, Zoho Books, FreshBooks. All of these typically have some basic level of financial reporting that they provide you. One of the key things that I will make mention is that not all accounting software provides you financial statements that are easy to use. A lot of times they try to dumb it down enough that you don't have to spend too much time on it, but using those and utilizing those come with some pitfalls. So we want to be aware of those. And we'll go into what a standard financial statement looks like and what that package looks like. And then obviously, and I'm pretty sure we have some CPAs and some accounting folks here on the list here in our audience. Accounting firms, they're typically the first ones that will help you build out these financial statements. Or if you have them from your software, they'll go through, vet them, they'll clean them, and make them a little bit more usable for yourself, for investors, and so on. That brings us to the next point. Who wants them? Who wants your financial statements, and what are they looking for from that? Typically, you have, for founders and startups particularly, the main one is the investor. They're usually the ones looking for some sense of how your business is doing, and they're looking for how what areas to pay attention to. And then obviously there's banks. If you ever have a bank that you need to either get a loan from, or a working capital line of credit, or any of that sort, they're the ones who are going to ask for financial statements as well. And lastly, you should want them. You should want financial statements to kind of help you track your progress. And one of the big things I will mention about financial statements is that financial statements are a lagging indicator. And by that, I mean that they're going to tell you information that's already taken place. So one of the key things to be careful about with financial statements is using those financial statements to predict without extra work, using just the financial statements to predict how your business is going to do. Want to be very careful of that. That typically requires a little bit more work and testing of your assumptions. Okay. So with that, we'll kind of dig into some of the basic financial statements. There's three main ones that almost everyone will talk about. There's your income statement, there's your balance sheet, and there's your cash flow statement. Income statement gives you a quick rundown of how much income you've had, what your expenses are running, and how much money you're left with at the end of the day. There's a little bit of nuance in there because it's a little different from a cash flow statement. The cash flow statement is going to give you exactly that, how much cash came into your bank, how much cash left your bank. And timing differences between the two are going to give you different information because of that. At this stage, the cash flow statement is often, I think, near and dear to our hearts. As a startup, as a young company, we're really concerned about finding a deal, making sure we can close that deal, and collecting the cash on it. That's really what we're driven by, and then growing that into a scalable, repeatable process. So I want to start with, instead of the income statement, instead of the balance sheet, I want to start with the cash flow statement. And why is that? It's, again, feels a little bit more intuitive. When you're at a point where you're just getting your first few sales in, your first few demos in, and you want to know, okay, is this something that I can repeat and do over and over again? At the end of the day, cash is king. If somebody's going to pay you $1 for what you've got, that's what you're going to want to pay attention to. So, at this point, what I'd like to do is kind of walk through a cash flow statement, and there's two different kinds, and kind of talk to you a little bit about how to build those in. The more intuitive one, the one that we can most care about, and the one that we can think more logically about, is a direct method. In the accounting world, you'll see people talk about direct method and indirect method. The direct method is pretty much as it sounds. It's cash that came in, that hit your bank, and cash that left, that you had to pay for either contractors or your rent or your utilities and leases and things like that. And typically on the left side is what that'll look like. The direct method is you want to start with all the cash that you've received in a given time frame. Typically, this is your bank statement, right? If you go into your bank and you say, hey, let's download a bunch of transactions, this is what you're getting, is the cash that came in either from customers, cash that came in from investors or note holders, cash that came in from interest income of any sort, things like that. You want to start with that as all the positives that hit your bank account. The next piece is all the cash that you're going to be paying for your contractors and your landlords and your office space, your technology costs, anything that you're writing a check to or doing a direct deposit for, that would become your cash paid out. And what you get is your cash provided by operating activities. The key thing about cash flow statements is you want to break this out into major forms of activity. Operating activities is typically what really runs your business. It's your day-to-day, this is what I'm selling, this is what I'm getting paid for. And in order to sell what I'm selling, these are the other things that I need to pay for, either my people, my contractors, my technology costs, and so on, to deliver what I just sold. That constitutes operating activities, typically. Then what we have is investing activities. So for example, if you are a, let's see, a grocery delivery company, and you're offering people the ability to, purchase groceries and then you're going to deliver it to them. Well, you probably have either vans or you're probably paying someone mileage or things like that. But if you have vans and if you're actually investing in buying trucks and things like that, that would be considered an investment activity. In other words, you're putting in extra capital into your business to help you achieve what you're trying to do. And it's that one investment is spread across multiple types of activities. So you're going to be, delivering groceries for 50 different families. Well, you're going to invest in one or two vans to kind of, have geographic coverage. That becomes an investing activity. Then the last piece of it is finance activities. Financing activities would be if you have a bank loan, or if you're running a raise from your investors, or going through a convertible debt round. That's where the financing activities. This is anything that has to do with the ability for you to actually have money to run your business. This is how typically, financial statements get broken out, is your operating activities, your cash and investments, whether you're buying a building or something like that, and then financing, where you're getting your cash and how you're using it, typically loans and investors. Now, what happens is this is how we typically think about. We like to think about cash coming in, cash going out. This is what I understand. And the way to build that is start at the most granular level. If you have a few customers, you can write them down into a spreadsheet. Each row is a customer, and you're writing down what they're paying you as you go. That's your cash in. Then you do the same thing for your vendors. Write down your vendors that you've got, and you write down how much you're paying them each month, and you can break it out. And then at the end of the day, that's what you have left. The amount of money that came in, came out, that's your change, and then you have your balance. So I started with $10,000, let's say, and I got $50,000 from my customers. I paid out 30, and then what's left is the difference between that 50 and the 30, and plus the 10. Okay. Normally, though, what ends up happening is as you get as you grow and you start taking in more money and you have a little bit more throughput, you start sophisticating your financial statements. And so typically, more like QuickBooks particularly, I think Xero does this as well, and your more sophisticated financial packages, they use what most accounting firms use, which is the indirect method. This is a little harder to go through at an early stage, only because it's not entirely intuitive. If you're an accountant, you get it. If you're not and you're just worried about growing your business, this is a little off of left field, because you start with net income and then you have a bunch of adjustments that take place based off of the balance sheet, based off of the change in the balance sheet. What's implied here is the difference between cash accounting and accrual accounting. And I'll get into that a little bit more, because that is a key. I've seen a lot of founders, get tripped up on that. Whenever I've seen any financial statements that have come to me initially, they are usually either on cash basis as opposed to accrual basis. Now, many of you may already know this, and it's old hat. But if you're just starting out and you're like, how do I need to present my financials? That becomes there's a bunch of caveats that we have in there. So then from the indirect method, what we have is, you start with a net income, changes to your balance sheet, gives you your operating activities. Your investing activities aren't that different from a direct method. And then your financing activities, that's also pretty straightforward from a direct method as well. So again, cash flow statement, I like to start here because it's the thing that we typically care most at this stage. I have just a few customers and I just want to close a deal and I want to see how my bank balance is doing. Okay. So moving on, then the big one, which is the income statement. How do we build an income statement? On the left side, you'll see here is a sample income statement that we've pulled. And on the right side, it's kind of breaking out what we're talking about. Basically, again, this is relatively intuitive. You have what you're gonna make from your sales, you have what you're gonna be spending, your expenses, and that's your net income. There's a little bit of nuance here, which is what I've broken out with the yellow bracket there. Expenses get broken out into a number of different pieces here. Got your revenue and your cost of revenue. We'll dig into that in a second. Then you have your operating costs, you have your non-operating costs, and then you get to your net income. So what do we have in terms of cost of revenue? What does that mean? And here's a truth. Cost of revenue requires some discussion. If you're a manufacturing company or you're building widgets or something like that, cost of revenue is comparatively a little bit more easier to identify. It's literally the cost that you have for providing a particular sale. What's at an individual level, right? What are the costs that you can trace directly to generating the revenue? So let's take an example here. I'm making laptops, the raw materials. You probably have, I'll understand this piece of it. Raw materials is something that I need to have to be able to sell my laptop. That becomes a cost of revenue. But then there's a little bit more nuance into that, right? I have to assemble a bunch of my laptops. So then there's assembly cost, right? The salaries that I pay folks to put the laptops together. But then what about the machinery that I'm using to put these laptops together? Does that go into cost of revenue? If so, how much? The cost of revenue is something that definitely you want to have a little bit more thought around. Here's another example that's outside of manufacturing is a software company. So you're building software and you're selling software online to companies. What goes into cost of revenue? What does that constitute? Would you say that the developers who built the software, that should go into cost of revenue? Possibly. A portion of their salaries, a portion of some technology costs required. Say as part of developing your software, you had to license a very specific piece of technology. Would that go into cost of revenue? There's a lot of discussion that needs to happen around this. Typically, software development costs, engineering costs, typically don't get allocated to cost of revenue, only because it's something we spread across for the entire organization. That's the entire worth. It's actually intellectual property. And so in a lot of cases, engineering, software development costs gets capitalized as intellectual property, if you will. One of the other things that can go into cost of revenue, though, is customer success or account manager fees. And again, this requires a little bit more discussion. So we've had customers where you might have a account management team, a customer service team, who are responsible for onboarding your customers for your software, for example. I have had clients who decide to allocate all of their customer service salary costs as cost of revenue. I also have customers who don't, and they only allocate a portion of their customer service departments into cost of revenue. So again, it's a question of what is it that drives the sale and whether or not there are components of it which you can trace directly to that sale. a good discussion I've had in the past with several of my colleagues is sales commission. Say you have a format where you are going to, you have sales reps on your staff and you're doing a lot more outbound sales. And you're incentivizing them. You're giving them a percentage of the sale. Well, should that sales commissions be part of cost of revenue or not? And again, I've seen this play out in a couple of different ways. Do you have, a portion of the sales commission get into cost of revenue, or none of it does? Again, that's a discussion for the kind of business that you have. That revenue minus cost of revenue, that gives us our gross profit. And a lot of investors and a lot of banks and so on will ask for, hey, what's your gross profit margin? And that's typically just the percentage, right? So over here on the left side, you'll see gross profit margin of 76%. What we're saying here is that your gross profit after your cost of revenue divided by the revenue is your gross profit margin. Again, this might be old hat for many of you, and this might be brand new to some of you. The reason for gross profit is essentially the question we're trying to answer with gross profit is how much is left over, how much of your revenue is left over after the direct costs of delivering that sale. Because we've got other costs we got to pay. We've got to pay administrative salaries. We've got to pay building office costs. We've got to pay training costs and technology costs. How much money is left over to cover all that stuff? In cost accounting parlance, we call this a contribution margin, if you will. There's a little bit of difference between gross profit and contribution margin, but it's at the end of the day, we're trying to figure out how much money is left for other operating expenses. So then we get into our operating costs and non-operating costs. Operating costs, typically, these are everything else. Your IT, your rent, your salaries, your marketing costs, your technology costs, any kind of servers or co-locations and so on. That's what we would bucket into here. And at this stage, one of the big things to be careful about is as you're building out your operating expenses and your financial statements, don't go overboard. That would be the key recommendation I'd have is don't go overboard in trying to itemize every single cost that's out there. Marketing, there might be a number of different marketing initiatives you might have. You don't need to break out all of them. You don't want to get into such minutia that it becomes difficult to read your financial statements. You want it at a functional level. Same kind of thing from a cost of revenue. I went into a lot of detail about cost of revenue, but the reason for that is to kind of help you understand there's nuances involved there. But that does not mean that those nuances need to translate into what you actually read and present from an income statement. Your investors and bankers will be looking at the big numbers, namely your revenue, your gross profit margin, your net profit margin, and then from an operating expenses standpoint, they'll look at probably departmental costs. So one of the things that happens when you create income statements is people want to see different kinds of information on there. And it's kind of up to you in conversation with who's going to use your financial statements to give them the most functional and usable level of detail that you can. The non-operating costs, the reason why we break that out is because it's not something that directly affects how you run your business on a day-to-day basis. And by this, what we're talking about mostly is interest expense, dividend expense, and taxes. Now, there are probably a few tax folks on the line being like, hold on, you got to include taxes. It's a pretty important thing. And you're right, it is, taxes do come into play. However, in terms of running your business on a day-to-day basis, you're gonna make that sale, however you're gonna make that sale, and you're gonna have costs regardless. Taxes, we're gonna come to you at the end of the year, and you're gonna want to allocate for it, but these are organizational wide, and they're ones that you can't necessarily avoid. Interest expense is something, if you have a loan or a line of credit, you're gonna be paying on that, but that's something that helps you from a financing perspective. It's not the stuff that's, actually, the activity around making a sale, an activity around growing your business. Same kind of thing from dividend expense. I'm not sure if too many startups today have to worry about dividend expenses. Hopefully none of your investors are asking for dividends. If they are, I think you should think twice, but that's just an opinion of mine over here. At the end of this whole process, you have your net income, and then you have your net profit margin at the very bottom, which is again your net income divided by your total revenue, 25%. And the key thing here that I'll point out is a lot of, as I mentioned, investors, bankers, they look at some of the big numbers, especially at this stage, right? They want to know that you're growing. They're going to pay attention to your revenues. They want to know that you're generating those revenues relatively leanly, right? So if your cost of revenue is extremely high and your gross profit margin starts off at like 30%, you don't have a lot left for the rest of your operating expenses. So they do pay attention to what goes into your gross profit margin. And then at the end of it, they want to see your net profit margin. We want this typically to be positive, although at a growth stage, in a lot of cases, a lot of startups, they're usually operating at a loss. And they're covering that shortfall from funding from investors and from banks or friends and family and things like that. So we'll get into that as well. The next big piece here that we have is your balance sheet. From a balance sheet standpoint, on the left side is a sample balance sheet. Now, balance sheets typically don't rise to the occasion for a majority of founders, and even even up to Series A, and from experience, because balance sheet is something that is a point in time display of where your company is and what it looks like. It's effectively just a snapshot of what kind of assets you have, what kind of who you owe, and what your end worth is at the end of the day. So accounting folks will probably know the equation on the right. Assets is equal to liabilities plus equity. I rewrote it as assets minus liabilities is equal to equity. And the reason why I rewrote it is because for founders and for folks who are not accountants, what is it we're talking about when we're talking about a balance sheet? Essentially, it's what we have, which are our assets, what we owe or we have obligations for, which is what our liabilities, ends up, and what's left over is our worth, which is what we consider our shareholder equity. So I gave you a great example here just to start off. If you start your business today and you have $10,000 of your personal cash and you put $10,000 into your business, well, what do you have? Well, you have $10,000 of cash. And so your assets show $10,000. So then what's your company worth? Well, I have $10,000 in cash. I don't owe anyone anything just yet, except myself, but I'm going to ignore that because I like my business. So the worth of my business is 10,000. This 10,000 minus 0 is equal to 10,000. And that's, I want to cast it in as a simple format as possible because I don't want the details to detract you from what the balance sheet helps you evaluate. On the left side, you have an example of this. Different kinds of assets, the things that you have. On the right side, the top portion, you have your liabilities, which is things, people you owe things to. And then you have your equity, which is what's remaining. And we can dig into this a little bit. On the asset side, what you have, there's a few different things that financial statements will do. They typically like to break things into what's short-term and what's long-term. And whatever is short-term, they consider current, and whatever is long-term, they consider long-term. And the definition typically from an accounting standpoint is that current assets are what's going to take place within the next 12 months. That's short-term. And then long-term is anything beyond 12 months. So if we're digging into it, current assets is anything that's essentially stuff that you can turn into cash relatively quickly. There's obviously nuances and differences in there, but for the most part, we're talking about cash and what they consider cash equivalents. At this stage, you probably don't have too many cash equivalents, but typically it's things like cash, or if you have stocks or something like that that you can easily sell on the stock market. That's what they consider as cash equivalents, or CDs and things like that. Then you have your accounts receivable. Accounts receivable being you've sold something to someone and they owe you. Accounts receivable basically just tracks what your customers owe you. And they consider this current because hopefully you're collecting your cash from your customers within 12 months. And hopefully within 30 days. So it's something you can turn into cash relatively quickly. Inventory, if you're an inventory business, if you have inventory that's sitting in your warehouse or something like that, how quickly can you sell it? Again, accountants know that there's a little bit of nuance involved into whether inventory should be current asset or not. Typically, just by default, we consider that current, because we hope we can sell our inventory within the year. Prepaid expenses. What are prepaids? This is basically, say you have a software or technology you bought, and they want you to pay for the whole year up front. Well, typically what happens is, like, you haven't used your software, you're only using it as you go, but you paid for it all up front. It's sort of like giving me an advance, or paying somebody in advance, right? You've given them a lot more money, but you're using their service or their product over time. That's a prepaid expense, and we consider that an asset because technically, if you cancel, depending on your contracts, if you cancel, you should be able to get your money back, hopefully. Again, there's a little bit of nuance into these things. All that to say, those are current assets. Then you have something that's a little bit longer term, like your property. If you've bought land, or if you bought equipment, your vans or your leases, things like that, go into longer term assets. And then we have other assets like intangibles. And this is where intangible assets, again, lots of nuance there, but typically this is software development costs and things like that, where you're capitalizing your team's effort and so on, and you're putting a dollar value to it and saying, hey, look, this unique software that I've built, or this unique process that I've built, has value to it because of all the time and effort we've put into it. And this is what we're considering that value to be. And it's what we have. When you go to ultimately, hopefully, exit and sell your company to another company or to IPO, part of your assets, part of your worth is that intellectual property. And so understanding how to put a dollar value to that becomes important. And that is assets in a nutshell, right? So you've got the things that you have in your organization. And again, these are snapshot numbers, right? It's as of December 31, this is the stuff that I have. Now, on the other side, we have liabilities. This is stuff you owe people, your vendors. Again, accounts payable is stuff you owe. In other words, they're already providing you a service. You just haven't cut them a check. They've invoiced you, but you just haven't paid them yet. So that invoice is technically a payable. It's something you owe. So notes payable. Notes payable are essentially somebody's given you a loan, and you're obligated to pay them back. Accrued expenses and deferred revenue. This can get a little bit hairy, and at this stage, at an early stage, my recommendation is seek out an accountant, seek out a professional who can help you work through deferred revenue particularly, and accrued expenses. What these are is it's digging into an accounting concept of, hey, these, I have the right to claim income, but I just haven't earned it yet. In other words, I've sold something, but this person is using it as they go. And so they're going to pay me, or I have a right to claim revenue as they go. And that's typically what goes into deferred revenue. Accrued expenses is, I know it's an estimate of what's going to be coming. So for example, say you have, you've engaged a law firm, right? and you know that you're going to need to pay them $15,000 for whatever, some kind of a contract review work or some, formation, company formation work. They haven't invoiced you yet, but you know that you're going to have to pay them. You put it into accrued expenses. It helps you track that, hey, even though it's not in my, the invoice hasn't come through yet, I expect to need to pay this. So that's what accrued expenses go into. It's your estimates for what you're going to have to owe. These are all current liabilities, right? So this is, again, everything that you need, obligations that you need to fulfill within 12 months. That's that liability portion. Then you have your long-term. These are longer-term portions of a note. Say you have a loan from someone that you're going to be paying off over 3 years. That's where the long-term debt would go in. And then from a shareholder's equity standpoint, this typically does not rise to the occasion for most startups, at least not this particular presentation of it. We'll talk about cap tables. It's one of the slides that's coming up. Cap tables from when you raise capital from investors or you have a note, things like that. That's what we'll talk about then. That's where this comes in, but it's essentially an accounting of equity and shares that you've given to your investors. Who owns stock? How much did they pay you? And then at the end of the day, how did net income flow into here? The one key thing that I do want to point out in stockholders' equity here is that your net income, if it's a positive or a negative, shows up in here as retained earnings. You have to, and this often gets a lot of folks, because what we're trying to do is, again, remember, the balance sheet is a snapshot in time. So if you're reporting as of August 31, you want to say, hey, what's my company look like? What's my worth as of August 31? Well, you do want whether or not you had net income or net loss as part of that worth conversation. You want to know if you had a net loss, how did that affect my worth? And here is where you account for it. If you had a net loss of $50,000 in August because sales dropped or something like that, then you want to show that my worth is a little bit lower because of a bad month in August. And this is where typically it gets booked, is in the retained earnings section. Again, don't let the balance sheet scare you, because it is a snapshot in time, and it typically does not rise to the occasion until you're ready to present to your investors and so on. And again, by that time, you're probably engaging an accountant, or you have at least a CPA or someone on your staff that can help you build this out. From an investor standpoint, they'll look at this, they'll look at certain ratios surrounding this, but most investors, most angels at this stage are looking at your growth rates. They're looking for into the future more than they are knocking you down on the financial statements you present now. All of this stuff is all lagging indicators, right? It's everything that's already happened. So using this is important from a historical track record, but we have to do a little bit more work before we can get into using it to forecast or predict how you're going to do further down the road. And that is a conversation for Friday's session. Okay. So we've gone through cash flow, income statement, and balance sheet. And all these three work together. You're going to spend most of your time on the cash side. You're going to look at whether or not you have adequate cash at the end of the day in your bank account. And then you're going to start looking at the income statement to show you how you did during a particular time period. How many sales did we have? How much did it cost us to generate that sale? What other costs did we have for it? And how much money did we end up making or losing off of that? So here's a good question, right? So you've been running your business for a while, and you continuously see negative net income, right? Net loss, month after month. And the question is, like, if I'm constantly generating net loss, how am I operating? Well, what's happening is that you've got some cash sitting in the bank, and you're depleting that cash. So a lot of times what I like to do with startups and folks at an early stage is show them the relationship between how their net income is working and then how that's, if it's steady net loss each month, show them how that's affecting their cash balance. And that talks to something that investors really want, which is your cash burn rate. How quickly are you burning through the cash that you've generated from a raise or from notes? If I'm going to give you $50,000, how quickly are you going to burn through that? You'd look at your income statement over the past few months, come up with a decent average of what your costs are, your average costs on a monthly basis, and then apply that to your cash. So if you're running at $10,000 a month of net loss, and I give you $50,000, then I know that you're going to run out of that $50,000 in the next 5 months, and you're going to need another cash infusion. So that's something to understand as you're looking at these financial statements, is the interplay between them. And there's a lot more resources out there, and if anyone wants additional detail on this, I can post this on the chat. There's a lot more resources around the interplay between your financial statements and how they work together. Okay. I mentioned ratios. I mentioned investors will often look at ratios. And again, this is a little bit more sophisticated, and it's important and necessary, but it really depends on the kind of business that you're running. And I bring this up here primarily because these are important as you grow and as you scale, and you want to have a good sense of specific things. So starting on the right side, we'll get into working capital in a second. Starting on the right side, profitability ratios. We mentioned this already, right? Gross profit margin, net profit margin. Then there's operating profit margin, and then EBITDA. Gross profit margin we already talked about, right? We want this to be, if this is too low, if your margin is too low before you even get to your operating expenses, you're in trouble. You need to spend some time thinking about how it is that you're delivering your service and what it's costing you to do that. Gross profit margin is almost like you should have some decent unit economics, right? Per deal, are you making money per deal, per sale? And as long as you're doing that, then you know that your gross profit margin is going to be relatively high, because you're trying to optimize for it every time you have a sale. As you grow, this becomes a little bit more nebulous because you might have more, different kinds of things that you're selling, you're bundling, whatever it might be. But that's where the gross profit margin comes in. Net profit margin, we went over this as well. The operating profit margin, the reason why this is called out separately is because of those non-operating costs. Sometimes interest expense and dividend expense, depreciation, amortization, that stuff often is not directly related to you running your business. Operationally it is, but from a financial standpoint, it's not going to give you, it's going to skew your numbers. So a lot of times folks want to pay attention to the operating profit. And that's basically your revenue minus your cost of sales minus your operating expenses. And that gives you your operating profit. On the top right, I'll talk about this very briefly. EBITDA is not something that too many investors at an early stage look at, because interest, taxes, depreciation, and amortization. What this stands for is earnings before interest, taxes, depreciation, amortization. It's typically not a thing for startups. You might have some interest expense. You might be surprised if you have any taxes, except for state filing fees kind of thing. And depreciation and amortization, those are there, but again, looking at EBITDA, a lot of investors don't, at this stage look at that. It becomes more important as you scale and you have more sophisticated investors on board. Okay. Shifting over to the left here on working capital, this is relatively important for a lot of companies, especially if you have a little bit of a sales and collection cycle, and definitely if you have inventory. So where do these become important? So we talked about receivables on the balance sheet, accounts receivable. This is stuff people owe you. So if people owe you something after you sell them something, how quickly are you collecting on it? And this top ratio helps you identify how quickly you're collecting on your sales. If you're invoicing someone and they typically pay within 30 days, your receivable days is 30. But if they're taking 60 days or 90 days to pay you, you're out of cash sooner, because you're just not collecting on it as quickly. So receivable days is something that a lot of companies pay attention to, especially if they are on an invoicing cycle, especially if you're working with enterprise companies where you have to invoice them and they're not paying you through like a credit card or something like that. Skipping down to the bottom, payable days, same kind of thing, which is typically when you're looking at managing your cash, you want to speed up how quickly you collect, and you want to delay paying your vendors as much as possible within your contract terms, right? So if they're saying, hey, you got to pay, somebody sends you an invoice, it says net 30, you want to pay them around 20 days or 25 days so that you can hold on to your cash a little bit longer. This is classic working capital management. So we want to make sure that you're collecting your receivables as quickly as possible, and then you're paying your vendors as close to the due date as possible without souring relationships. If you have a really good vendor that you absolutely need to make sure that they're clocking for you and that they're delivering for you, you want to prioritize them and you want to make sure that they're doing a good job. You might want to pay them sooner. But for others, you might want to delay paying them a little bit. That's where these working capital ratios come in. They help you identify how long you're keeping your cash in your bank as you operate. Inventory days. I don't know how many inventory-based companies we have on the call today, but typically what this is talking about is how quickly are you turning your inventory into sales. And the longer that inventory sits in your warehouse, the longer that quote unquote cash that you spent to create that inventory is tied up. We want to free that cash. And so paying attention to your inventory days is something that's really key. Again, I don't know how many inventory-based companies we have. This is something to pay attention to. All right. Lastly, a couple of caveats what we have in terms of financial statements. What's in that, what's not in them, and some things to be careful about. Performance indicators. These financial statements are not going to give you performance indicators. They're not going to give you your customer acquisition costs. If you're a SaaS subscription company, they're not going to give you your ARR, your monthly recurring revenue. They're not going to give you your lifetime value or your gross marketplace value. If you're a web company or like a mobile app company, they're not going to give you your typical average user metrics and so on. These are all metrics that you have to develop outside of this. They're technically a little bit, they're not as much financial metrics as they are operational metrics. On the right side, and these two kind of go to get a hand in hand, GAAP accounting warning and cash accounting warning. So I mentioned the difference between GAAP and accrual accounting. And the key thing to keep in mind here is that a lot of companies, when they first start out, they're worried about cash, which they should be, and they look at financial statements from a cash standpoint. You've got to be careful a little bit about this. Cash accounting recognizes and records transactions when cash hits the bank account. What this does is it kind of makes reading a monthly financial statement a little difficult, because what's going to happen is, say you make a sale in August, but you don't get paid until November. In a cash basis income statement, you're going to see revenue come up in November, not in August when you made the sale, because you collected the cash in November. What will happen is you'll get a really lumpy financial statement. There'd be some months where you collected a lot of cash suddenly, and some months where you didn't collect enough cash, and so it's going to look like you didn't generate enough revenue. So that's something to be careful about from a cash standpoint. It works the same way as in terms of how you pay people. If you pay people all at once in 1 month because you got all this cash, and then the next month you don't pay people, then your net income is going to spike up and down and go up in the negatives and the positives each month. By the same token, GAAP accounting is good for normalizing that, for making it an easier read. But one of the key things about GAAP accounting is that there's a lot of nuance here that don't necessarily help you run your business. One of the key things to keep in mind here is that deferred revenue, for example, for a lot of SaaS companies, and you know, caveats aside, the deferred revenue is not the same thing as bookings. It's not the same things as booking a sale with a customer. Deferred revenue requires you to stretch out how much when you recognize the money that you booked from an annual contract, things like that. So there's these nuances inside GAAP as well. Again, work with your accountants to help you understand what it is that you're looking at when you're looking at your financial statements. Finally, no offense to all our friendly accountants, they are detail oriented and they're excellent for holding us accountable, and we need that. But one of the big things we got to be careful about is not letting these accounting technicalities drive our decision making. The only exception I'll make there is for tax ramifications. If there are key tax ramifications there, definitely work with your accountant on that piece. Okay, last little bit, and then I'm gonna open it up for some Q&A here. If there's any questions, I do want to talk a little bit about cap tables, and this is this is it's not a typical financial statement, if you will, in the classic sense, but this is something that typically, at least some investors may look for, is to understand how your company is capitalized from other investors. And some of you might recognize this is there's an example from Carta that they put it on, they posted on their website. Basically, this is keeping track of all your investors, how much money they've given you, what series they're part of, and how many shares you have outstanding, how many options, and things like that. This is really important as you start fundraising, keeping a good track of who your investors are, how much money they've given you, and how much of your company you've given away. Towards the bottom here, you'll notice that it's giving you some percentages, right? You've got your fully diluted ownership here under common shares of 35%. Series A is 44%. This is telling you how much of your company is left for the owners, how much company is owned by investors, by note holders, things like that. Carta is effective, I think, for the most part, is the go-to right now for startups in terms of tracking investors and how much money they've raised for what price. And I highly recommend keeping looking into Carta or other similar cap table software out there to help you with this. That is a quick rundown in 50 minutes of these financial statements. I didn't want to get into too much detail and give a chance for folks to send in some questions and then remarks on this. There's a quick Q&A session. Pardon me. There's a Q&A session. If you want to ask any questions, please go ahead and post them up there. I'll do my best to kind of get through as many of them as they come through. All right. So one of the questions that came through is, should deferred compensation to founders be on the books? I've been told to include them, while others suggest it should not be on the books. What are your insights on advice? That is a great question. The conservative answer to that would be to include it, only because it's sort of like the liability, right? You have a compensation piece that you're going to have to make good on at some point. I would advise that you would put it on your books. Now, there's questions as to how much of it and things like that you want to get some details on. But in my opinion, I think that typically I've seen deferred compensation listed on the books under the liabilities, because it is a true liability and obligation of the company if that's how you've contracted with your employees to do that. And there's specific accounting rules around there. And also, deferred compensation has tax ramifications around it as well. So keeping track of it is definitely key. And when you're presenting your financial statements to investors, I advise giving them as complete of a picture as possible. to include that in your books. So that would be my take on that piece. Okay. There's a question here as to, like, you know, how do we translate some KPIs into the financial statements? And that's the key. There are KPIs you can derive from your financial statements on a monthly trend basis and things like that. But financial KPIs are different from your operational KPIs. And one of the things that I'd make mention, and I'll post this link, but Steve Blank has a really good comment on this, which is the financial KPIs that you derive from financial statements are not necessarily the right ones to pay attention to, especially at this stage. What you want is your non-financial KPIs, which help you, drive sales, grow your business, and to optimize your business as you're looking for either product market fit, or you're trying to turn it into a repeatable process as quickly as possible. So there are plenty of articles, and again, I'm more than happy to list some links here to where you have, financial KPIs that you can use. But I'd recommend paying more attention to your operational ones at this stage. Okay. All right. Well, it looks like we have just a couple more minutes here. If there's any other questions or anything like that, by all means, please go ahead and send them through. I will. This will be recorded. This is recorded actually, and I'll work with the Buffalo Startup Week group to post it, and then we'll send out links to all the attendees here. I hope that you all took away some nuggets of insight from here. If there's any questions or anything like that, please feel free to reach out after the fact. I'm more than happy to help anyone who has questions on this. Otherwise, thank you so much for your time. I really appreciate it. A whole hour of your time is very valuable. There's one last question that came in. When should you start working with a bookkeeper, CPA, tax lawyer? Great question. So with bookkeeper, I would say as early as possible. Once you have a decent number of sales, get a bookkeeper in to kind of just keep your books clean and on point. With a CPA and tax lawyer, CPAs, I would say within a year, definitely before you start raising money of any sort. You want to have a CPA and a tax lawyer on board before you start raising money. So even if it's at a seed round, have somebody at a CPA firm or someone look through your books and kind of give you some pointers and clean them up for you. But a bookkeeper as soon as you can, as soon as you have enough cash to do it. Okay. On that note, folks, really appreciate everyone's time. Again, feel free to send out any questions after the fact. Really, thank you for joining us here on Financial Statement Basics.